This week on Wealth Track, how to maximize the effectiveness of your charitable giving with Pamela Norley. She's the president of Fidelity Charitable, the oldest donor-advised fund in the country, and Elda D. Ray, personal tax and financial planning specialist at EY. They're next on Consuelo Mack Wealth Track. Pam, as I said in my introduction to you, that you are the president of Fidelity Charitable. It is the largest and oldest donor-advised fund in the country. Donor-advised funds mean that you can give your charitable donations now, but you don't have to give them. You can take the tax deduction now, but you don't have to give the money right away. So tell me how donor-advised funds work.
Right, so exactly how you just described it. It's a giving account that you can use for philanthropy. Basically allows you to make a contribution into an individual account or a family account, take a tax deduction for that, invest that money. It grows tax-free, and then it comes out tax-free with a recommendation to a charity. So we've spent the last 25 years trying to make giving accessible, simple, and effective. You know, accessible in that we have 150,000 Americans who have a donor-advised fund with Fidelity Charitable, who are using it to do their granting. They're investing it in various portfolios, watching that money grow tax-free, and then they have more money to give out to charity when they come to the time that they want to consider which organization they want to support. So last year was a phenomenal year. Our donors gave away $3.5 billion.
So I can give my money to a donor-advised fund, for instance, and I lose control of that money.
Yep.
Right.
Yes.
However, I still have control over which causes I give to, and that's something that a donor-advised fund helps a donor with.
Right.
So you call them giving accounts.
Yeah,
right?
so giving account is sponsored by a nonprofit or a trust.
Right.
We have an independent board of trustees that oversee this. And basically how it works is that you put your money into your account, it can grow tax-free, and then you make recommendations for the charities that you want to support. There are 1.5 million charities out there, and it's really important that these be legitimate charities. So we do the due diligence on behalf of the donors to ensure that these are 501c3 legitimate, that
right.
they're in business, that they're keeping up with their filings.
Elda, when do you recommend to your clients that they use a donor-advised fund versus a direct give, for instance?
Well, a direct gift means you have to align having the asset or cash at the same time as the need for the charity, and you've identified the charity. I recommend donor-advised funds or private foundations when it's advisable to separate the time of the gift to the time that the charity should ultimately get the gift. And that could be because you have a unique event in your life, you're selling a company, you own a stock that's highly appreciated, and it's a good time from a tax standpoint to give that asset and get a deduction for its value. You may not be ready for that charity. You may not have identified the charity at this point in time, but you know that you have assets which you ultimately want to have go to charity. Yeah. People who are busy in their working lives haven't spent the time, perhaps, working with charities or knowing who exactly they want to fund, but they do know ultimately that they do want to fund a charity. So from a tax perspective, give it when it's the right time for that asset value, or based on your marginal rate, based upon what your tax policy is at the time, and leave it to when you have more time to investigate where that money should go. Picking the vehicle, a DAF versus a private foundation. Foundations are hard to set up.
Right.
They're costly. If you don't do the right thing in the way they're managed, there are numerous penalties. So unless we're talking about millions of dollars, I typically would recommend a donor-advised fund. And I think it's great that sort of the average person who has, I think it's maybe a minimum $5,000 to gift, can take it, have essentially the same tax advantages that someone who could afford a private foundation in order to get a deduction now and identify the charity later. So it brings that tax technique as well as the ability to fund future charities down to the more mass affluent.
Yeah. What are the disadvantages to donor-advised funds? Are there any downsides, negatives? When would you not recommend it to a client?
Well, they have to be ready to part with the money to give the money to a donor advised. It's not theirs anymore. No. They can't take it back. They can suggest where the monies go, so in terms of the ultimate charity. They can suggest where it should be invested, but they can't use the money, for example, to fund, perhaps they find a venture that they think will have some promising, let's use an example, a vaccine. So they can't do program investing, things which perhaps if they had their own private foundation they could do. So it's more restrictive. However, it is a great vehicle for 99% of the population out there who does do charitable gifting, and they make it very easy to gift. So rather than under current tax law, you have to save every acknowledgement letter for every gift that's over $250. If you don't have the letter in hand when you go to file your tax return, your deduction could be denied, even if you have a canceled check. So some of my clients, the last thing they ever give me in the preparation of their tax return are the stack of acknowledgement letters, and we have to check off, did they receive all of them, or it's not a good deduction. So even for those that gift annually to their charities, I say, why don't we make this easy? One gift to the donor advised fund, one acknowledgement letter from that fund, and then we don't have to worry about all that paperwork for the 50 charities you want to gift to on an annual basis.